Hello Sector Watchers, welcome to the show. This is the 105th episode of Sector Spotlight for Tuesday the 16th of November, recording it on Monday the 15th. My name is Julius de Kempenaer and I am presenting to you from Amsterdam in the Netherlands. If you've got anything to share, have any feedback for us, please use any of the handles on the screen. The plan for today is that we're going to have our usual look back review of rotations that took place last week in both asset classes and sectors, and we're going to try to put them into a little bit longer term perspective. For the asset classes, I'm going to dive a little bit deeper into the US dollar and the relationship between stocks and bonds. I'm referring to the principle what I call reverse relative strength. After that, we're going to dive further into the sectors and highlight one or two sectors that are particularly interesting at the moment and look at the groups in those sectors where you may find some interesting names for your portfolio. Ladies and gentlemen, this is Sector Spotlight. Let's kick off with the review for asset classes. On the left-hand side, we have the weekly RRG. On the right-hand side, we have the daily RRG as usual. If we look at the rotations, the performance of last week, then we see the US dollar actually as the strongest asset class, as the strongest asset in this universe, and we'll dive into that a little bit later on, because the US dollar actually continues to strengthen, so that's a good sign. If we look at the rest of the performance, then we see that the benchmark lost 40 basis points, pretty much unchanged, and you see that translated in the rest of the asset classes. Stock market lost 20 basis points, that is virtually unchanged. Government bonds obviously a little bit below the balanced index fund, losing 70 bips. Weakest was corporate bonds with a loss of 1.4%. If we look at the tails, then we see ITOT and VNQ inside the weakening quadrant, with VNQ slowing a slightly longer and more powerful tail than ITOT, the stock market. So if we start with the stock market, then that's a short tail on the right hand side. That shows you a stable trend, stable relative uptrend in this case. It's going through a little bit of a pause, but if we bring that into relation with the weekly tail, then we see it's similar. It's a short tail on the right hand side of the graph, which means a stable relative uptrend, but this is pointing upward, and this is, well, sorry, wrong side. This is, you see that the tail length is shortening. That's very often something that's happening when a rotation starts to build up, and if we blow this up here, then we can see that the pickup seems to have started already. So I'm curious to learn how this continues. But the bottom line is that the performance, the relative performance for the stock market inside this universe on an asset allocation level is definitely still favoring stocks over bonds. If we go to bonds, then we see bonds here. They're obviously on the opposite trail as the stock market. Short tail on the left-hand side of the graph, stable relative downtrend. And if we look at the left-hand side here, then you see that bonds on the weekly scale are actually already dropping back into the lagging quadrant, which means that a new relative down lag is starting in government bonds. Now, the two strongest tails here on the weekly are both commodities, so GSG and DJP. The last week and a half, last 2 weeks, they lost a little bit of momentum. But if we look at how they perform on the daily, then they were dropping into the lagging quadrant when we spoke last week, because that was 5 periods ago. So 1, 2, 3, 4, 5. This was like last week. And then you saw the weakness coming into commodities that was causing this rollover here on the weekly. That has continued basically throughout the rest of the week, and towards the end both GSG and DJP started to pick up again. So the last 2-3 days they started to pick up a little bit relative momentum again, which confirms the idea that this rolling over of the commodity tails inside leading is temporary in nature, that the long-term relative uptrend for commodities is still in play. And the way I think it should be played is that, or the way I want to be looking at it, is I'm going to monitor when DJP and GSG will start to turn into that 0 to 90 degree heading, meaning that they are starting to gain on both scales of the relative rotation graph. That's usually a strong sign with usually good follow through, and that will help continuation of the longer term uptrend. Now, I've already mentioned I'm going to do two things. First, I'm going to look at the US dollar, and then we're going to look at the relationship of stocks and bonds, because there's some interesting things to look at there as well. Let's start with the US dollar. If you look at the US dollar, we have been monitoring that for quite a while already, and the direction is now definitely chosen. You see the improvement here on the RRG, the continuing improvement. And if you look on the daily chart, you can see that it's going back into sync. It's rotating out of that lagging quadrant, back into that improving quadrant, supporting the further improvement that we see on the weekly RRG. If you look at the chart of the US dollar, then last week was important because we now pretty decisively broke above that horizontal barrier that was in play for quite some time. That was a level 94.70, let's say 95. We're closed the week out at 95.13, and today the US dollar strengthened even more. And as you know, I'd like to look at that in euro dollar terms. That's the reverse, obviously, and what you see here is that big head and shoulders pattern that we identified a couple of months ago already is now definitely in play. We're on the way lower, and I think we're on track for a move towards the 111, 110, 111 area, which is the height of this pattern projected from the breakdown. So from an asset class level, for a currency level, I continue to see a further strength for the US dollar. Definitely versus the euro, but in general that goes versus most other currencies as well. If you look at the daily, then you got a little bit more granular view, and you can see that this was last week, this was Friday, and this is today, because this chart is already updated to today, to the 15th. And you can see a big move lower at the start of the week already, sort of confirming that downtrend that is in play for the US dollar. Enough of that. Let's have a look at the stock bond ratio. And I know we are looking at, in this show, I always use ITOT and GOVT, but for last week I was preparing for a new episode of The Pitch. Unfortunately, that didn't go through because Dave Keller, who's going to be hosting the show, was caught by a flu. He caught a nasty bug that prevented him, or made it difficult for him to speak, especially for a longer time. So we've rescheduled that show, so it will be coming. But I thought it was a bit of a waste to let the work and the research that I did for that show go unused. And one of the relationships that I looked at for that show was the stock bond relationship. But I used SPY and IEF. You know, the picture is not much different than when you look at ITOT and GOVT. I just think that GOVT and SPY, IEF maybe appeal a little bit more to the audience because they're more familiar names. The trend is, the story is exactly the same. But here's the thing. This is the chart of SPY versus IEF. And obviously we broke out, which was a very important breakout here. Let me bring up that line there. So this was in November 2020. It was basically just after the elections, which is pretty similar, and I've shown that prior in Sector Spotlight. Pretty similar situation that we had 4 years prior after the election. You know, this is a pretty similar move with a hesitation in the run-up to the elections, and then after the elections we got that move higher, and we got that ratio breaking above an important resistance level. That happened here as well. We rallied, then we lost some pace, We showed that. It showed up in the RRG. You saw that that government bonds went into positive territory and stocks went into negative territory. We held that for a while. But in the end, all what it did was a slowdown of the pace. It wasn't really a reversal. It was more a slowdown of that outperformance of stocks over bonds. And you saw that in the negative divergence in the RSI and to a lesser degree into the MACD. Now, a couple of weeks ago, we broke out of that newly formed channel at a lower pace and we picked up again. We accelerated again. Now, the longer term story here was that we were breaking out of a big base. And you know that when a stock or something breaks from a big base, you can sort of project the height of that range on top of the breakout level. And in this case, and these are all very rough calculations, so it's more to get a rough guide of what we can expect. So the height here was about 1.2 points, 3 points. No, 3 minus 1.8 is 1.2 points in this relationship. And we can add that to the breakout level, which was around about 2.93. So we're coming out around 4.2, 4.10, 4.15, 4.2. It depends a little bit on where you draw your lines. Roughly 4.2. Now, if you look back in my blogs, I have quite some time ago already written a few articles on what I call reverse relative strength. And what I mean with that, I can show you in a snapshot of a spreadsheet that I created. And what that does, it lists the prices of IEF on the top axis, prices of SPY on the vertical axis. And all the figures here are the SPY IEF ratio. So these numbers correspond with this chart. So you can see that the 4.09 corresponds with the levels where we now are. As you can see, the S&P is currently around 467, so that's smack in the middle of the red box that I had here. When I prepared this chart, IEF was around 116, but since then, it was last week, we dropped 2 points, so we're now around 114. And here is so this red box should now actually be here, and 409 is smack in the middle. Now, the dotted lines here represent the support and resistance levels on IEF. So resistance comes in around 118, support comes in around 112. For the S&P, I think the most important support level is around 450. And because we're trading to new all-time highs, there's no real resistance level to be marked. Now the green area shows you where that ratio is at 4.2. So this table basically gives you a rough guidance of what you can expect in terms of price for SPY and IEF based on your relative strength calculation. So assuming that that relationship will continue to rise and that 4.2 is our target area, what does that mean for IEF and SPY? And that's the green line here. So 4.2 is the middle and then a little bit above and a little bit below. So if SPY remains the same and IEF continues to drop, we can actually drop towards 112 without SPY rising, and we will reach 4.2. If IEF drops even further, then you can see that SPY could even drop towards its support level and will still be at the 4.2 level in that ratio chart, meaning that it's a minimum target and we're still on track, and there is not a big decline in that ratio, which means that we still have a preference for stocks over bonds. Now, in the event that IEF will rise, then SPY also needs to rise to keep that trend going higher. And you can see the levels here. So assume that IEF rallies to its resistance level around 118. We need 495 in the S&P 500 to remain at current levels. So this is not an answer to where things are going. This is just a tool to give you an idea of what you can expect, what sort of magnitude we're thinking when things start to move in IEF and S&P 500. Now, if the S&P starts to rise, then obviously we don't need as much of a rally in IEF to maintain those levels. As a matter of fact, when the S&P really starts to rise, we can easily break beyond that 4.2 level and continue higher in that stock-bond ratio. So I think the bottom line of this exercise, the bottom line of this research, of this overview, is that this trend is still going higher, and if we hold up, let's say above 4, we can continue to accelerate this ratio higher, keeping a preference for stocks over bonds. And then on to sectors. Left-hand side, weekly RRG for US sectors. On the right-hand side, the daily version. I'll make that a 6-day tail, so we can include today. Market has closed already a couple of hours ago. So what did we see last week in terms of rotation? As we saw in the overview of asset classes, stock market didn't do a lot. SPY also lost 20 basis points. But the spread between the sectors is pretty big. Materials picked up 2.1% and discretionary lost 3.6%. It's a pretty big spread in a week that nothing happened. That translates into the rotation. You see the big tail for XLY coming down. It's still, in terms of RS ratio, strongest sector. It's got the highest reading. It's inside weakening now, and it'll be interesting to see how this sector will behave going forward, how much more decline is needed, or did we shrug off the rapid rally, and did we see some sort of a digestion, and are we ready to continue higher? Time will tell. It's difficult to say at the moment. Other sectors, as I said, materials, very interesting, up 2.1%. We're going to dive into that one a little bit more. Together with industrials, because these, I think, are the two sectors that are worth our attention at the moment. If you look at the tails, you see very nice rotation of materials from weakening, just shaving off the 100 level, and then moving into the leading quadrant, powering off at a strong RRG heading. And then if we look at industrials, that went down a little bit further, went actually into the lagging quadrant from weakening, but has now started to turn higher, is pushing into the improving quadrant, and potentially further into the leading quadrant if all goes well. We quickly go over the other sectors, then you see real estate inside lagging, just curling up a little bit. Same for utilities, financials. Staples inside improving. Interesting rotation there. Chart, stealthily moving higher. Healthcare actually confirming the weakness in improving, rolling over, and now back into lagging. Technology holding up well after a strong week last week. Now sort of unchanged, but the rotation and the relative strength still holding up well, and that was the important level. Wrote an article in the RRG blog just before the weekend mentioning that finally tech is now breaking out, and what I was referring to is the breakout in terms of relative strength, because that has taken a while before that actually happened. Communication services picks up a little bit, but is still very low on the RS ratio reading. Energy picking up, still very strong long term, so we can see a move back into improving and leading for the energy sector. A bit early now, but keep an eye on it. And here is discretionary as we just discussed it. Let's quickly put that into a longer term perspective. Let's go back to materials and see how that works. So I always prefer then to put those tails at the same. So I sorted on tails so we can have both charts at the same tail. So here's materials showing an interesting rotation, because what you see here is that it was very short tail, picked up very short tail, and now it starts to accelerate over the last week and 1 day. And that's what you see here on that daily tail. So that's a good thing, and that could be an interesting sector, especially when you bring into account the actual chart for XLB, where you see that we broke out of a, say, a 6-month base, and we're still holding up above that 87.5 level. And I still have my old trend line here in that relative strength chart. What I usually do, that's a habit that I developed, is trend lines that I think are still very valid are a little bit more pronounced or brighter colors. And when they sort of start to fade, then I make them actually fade. And now looking at this chart, I should actually also do that with this trend line here, because that is now actually fading. So here you go. Here's your faded trend line for this chart too. This one is obviously still intact, and so are these ones. This is the breakout level. But more importantly, you see that the down move in relative strength is losing pace. It's curling back up. You see some sort of resistance coming in. That's being picked up by the RRG lines. If this break in price holds up, I do think that there is a good chance that the relative strength will push higher, and it'll push materials further into the improving quadrant. So it could be one of the leading sectors going into the fourth quarter towards the end of the year, which makes for an interesting observation. The other sector that I was referring to, and let's go over all of them. So we see communication services here on the daily. You see communication services strongly moving into lagging. So this is just a hiccup in a longer term downtrend. Energy is the other way around. This is still a very strong relative uptrend, and energy is coming back into sync. So when that happens, more is expected from the energy sector. Financials dropped off a little bit inside the leading quadrant, and that's what we saw, that rotation here on the daily through weakening and now in lagging, but already picking up. If that improvement continues and pushes it into improving and leading, then we'll keep financials inside the leading quadrant on the weekly chart. Here's industrials. That's the other one that I want to dive into a little bit deeper. Strong rotation, continue into improving, picking up nicely on the daily chart. So that's a sector to keep an eye on together with materials. Technology obviously continuing strong. We see the hook back up towards the leading quadrant. If this holds up, then it's a matter of time before technology ends up into the leading quadrant again, and it'll be one of the leading sectors. Staples moving lower, that's the weakness, and I think that it'll be very questionable whether staples will make it into the leading quadrant because of the weakness of staples on the weekly RRG. Real estate moving into lagging, and that is sort of confirmed. We see a little bit of a hiccup here. This is horizontal, but it is definitely moving to the left-hand side, which is a negative. Utilities, one of the defensive sectors, further into lagging. The hiccup here, but still a very low reading, and it confirms the weakness of the defensive sectors. That's probably still the most important signal that we can get from offensive defensive, is that the very clear underperformance for defensive sectors, which leads to the conclusion that the market is still expected to be strong. And here we see discretionary. We would like to see this shorter term tail to curl up inside weakening back to leading to maintain this longer term uptrend here. Now we looked at materials, and I want to bring industrials to your attention because it's showing some sort of a similar chart as materials, also breaking from a long-term base, and you see that the decline in relative strength has come to a standstill, has come to a rest, and seems to be bottoming out. So what you want to look at in terms of materials and industrials, what you can do is you can bring up the chart of the groups that make up industrials and materials. You can open these groups from the sector summary page by clicking on the RRG icon. And I already did that for you on these two tabs here. This one shows you the materials sector. As you can see here, this is materials. And this one is the industrial sector. So when you click on that icon, it will open up all the groups, including the sector index. Now you can see that aluminium here has been the big driver so far for this material sector to go higher. It's now rapidly losing and with a long tail moving into the weakening quadrant. These are all against the S&P 500 as the benchmark. If you want to have it versus the materials sector itself, just change the benchmark to materials and you will get an image of all those groups versus the materials sector as the benchmark. If you have an outlier like this, I'd like to tick it off and fit it again so I get a better group. And now I can very clearly see where in this materials sector my preference should be. And I think that the groups to look at are non-ferrous metals and specialty chemicals and commodity chemicals. Those are the three groups that are at a very nice, strong trajectory, at a strong heading, and outperforming both the S&P 500 and the materials sector. So within materials, take a look at the stocks inside those three groups and see if there are any nice breakouts taking place, whatever it is that you're looking at. But this helps you to zoom in on the groups that are potentially interesting to work with. If we do a similar exercise with the industrial sector, we have them here. Here are all the groups versus the S&P 500. If we change that to XLI, then we got all the tails of all the groups versus the industrials index. And then also we can immediately see a few interesting tails. I think that the ones that you want to... So TS is Truck Transportation Services. That's obviously still an interesting chart, but it has probably run too far. Maybe it needs a little bit more of a correction. You don't want to chase that. Trucking services, potentially the same. If we look at that chart for trucking services, we need to go to industrials groups, industrial groups, and then find trucking services, trucking index. Then you see that this is a move that has run a lot of its course. There's still plenty of room there, but you don't really want to chase it. So I'm trying to look at groups that are just entering. And one that I think I want to focus on going forward is the railroads section and the industrial supplier section. Those are groups that have just entered the leading quadrant and have a lot of potential to travel further. So stocks inside those groups make a lot of sense to look at. Ladies and gentlemen, I've got to wrap it up. This was Sector Spotlight for this week. I hope you enjoyed the show. If you did, you know what to do. Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern here on StockCharts television. And I hope to see you again next week, same time, same place.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.